Government shutdown, people losing their jobs, interest rates haven't come down. There's all of this excitement going on in the marketplace. I'd like to explain to you what's really going on. Well, September was an exciting month, and it's our fiscal year end. So I'm happy to look back on the year as well as on September and realize that, gosh, we've helped a bunch of families. And September was our second strongest month of the entire year because of the fact that buyers are now starting to come back into the market. I'm not going to take the time to describe a couple of the personal stories this month like I've done in months past, because there's a couple of events that have just happened in the last couple of days that I think need a little bit of attention. The first is, of course, the government shutdown. By the time you're viewing this, it may or may not be over. But the reality is, no matter whether it's still going or not, it's more of a political stunt than it is an economic event. Interest rates are tied in such a fashion to where the mortgage rates that we have today, which is around 6.25 as I'm sitting here recording this, that rate compared to the Treasury rate of 4.1 is only about 200 basis points, 215 basis points apart. That has been a narrowing event, which is improving rates. We're talking about 10-year Treasuries maybe getting to 380 next year. Not a big movement. But mortgage rates could come down more than that if we continue to see the compression of the spread. The historic spread between interest rates for mortgages and Treasury bills is under 200 basis points, or 2%. So even if we just got below 2%, we'd already be seeing rates right at about 6. So I wanted you to understand that, because people say to me, well, how far can rates go and how quickly? The reality is, no matter how many times the Fed funds rate is dropped, that's the overnight rate banks borrow from each other, and right now that's about the same as borrowing money for 10 years. Does it make any sense at all that the government can borrow money for the same rate for 10 years as they do for 10 minutes? It doesn't. And so that's why the Fed funds rate is going to continue to go down, and the 10-year Treasury bill is probably not going to move too much, which means that mortgage rates aren't going to have a lot more movement. However, there is one other thing that you need to think about, and that is that 1 out of every 5 borrowers in the United States today has a rate over 4%. Excuse me, over 6%. So those people that have rates below 4% are becoming less and less of a portion of the market. People don't move because of interest rates. And the handcuff of interest rates is different for each of us. Some of us want to downsize. Some of us have had babies in the last 12 months and maybe we need a new bedroom. Some of us have kids going off to college. Some of us have kids coming back home. Whatever those changes in life circumstances are, or maybe one of your kids is getting married and there's a new household formation. Those are the life events that become the building blocks of households that need a home. So if you've got a change coming up in the next 12 months, give us a call and let's plan a little bit. Let's strategize about what might be best for you when it comes to the security of your home as part of your financial plan.